Good evening to all. Welcome to our Forex Basics webinar. My name is Stavros Tousios and I'm the market specialist at FXPRIMUS. Today we will go through some basic points all of you should be aware and are also accustomed to. That will involve some information with respect to the Forex market in general, some theory on the products and market types, and of course some terminology that will help you understand the risks of leverage and margin trading. Before we get started, I would like to tell you a few important things about FXPRIMUS. FXPRIMUS is globally acclaimed for offering one of the safest and most secure online trading environments available anywhere in the Forex industry. Our extra measures in safety have positioned us at the front runner in responsible trading, and we are now setting new standards in safety amongst our counterparts in the FX industry. The company enables clients of all experience levels to trade over 120 instruments, including currency pairs, commodities, CFDs, and indices. You can discover an award-winning safe trading environment founded on the proven philosophy of success through security. FXPRIMUS sets the benchmark in safety for its industry-leading safety mechanisms. We were the first to offer client-funded insurance coverage of up to 2.5 million euros per claim and offer third-party monitoring for client withdrawals by boutique client trust. In FXPRIMUS, we are going the extra mile to offer you protection unseen anywhere else in the industry. Now, a little to know about me. I have traded professionally for over a year and successfully for over the past 2-3 years, and decided to take this a step further, actually by entering the Forex market as a Forex market specialist here in lovely Limassol. I decided to do so that I can share my knowledge, pass my knowledge to people that are starting, or to anyone that doesn't know a lot about the Forex market, or even to people that actually do have some skills. Feel free to connect with me on Twitter, LinkedIn, or send me an email, even if you have any questions related to this webinar. My goal is to share my knowledge as I mentioned above, so please don't hesitate to ask any questions. Please note that Forex trading and trading in other leveraged products involves a significant level of risk and is not suitable for all investors. Trading in financial instruments may result in losses as well as profits, and your losses can be greater than your initial invested capital. Before undertaking any such transactions, you should ensure that you fully understand the risks involved and seek independent advice if necessary. Any opinions, news, research, analysis, prices, or other information contained on this webinar or linked to from this webinar are provided as general market commentary and do not constitute investment advice. FXPRIMUS or its representatives do not accept liability for any loss or damage, including without limitation to any loss of profit which may arise directly or indirectly from use of or reliance on such information. So, without further ado, let's go to the first slide of Forex Basics. So I'm going to start with explaining what the Forex market is. Well, it really depends on how you look at it. Here's how I see it. Forex exchange is not just about going to the bank in order to exchange one currency to another. The foreign exchange market is the largest financial market in the world. It is open 24/5 from Sunday night to Friday, being available for investors, short, long-term, retails, or institutional during the full working week. On the charts provided by Bloomberg, the Bank of International Settlements counted that the daily currency trading volumes are at $5.1 trillion as of April 2016. Although no fresh data have been yet provided for 2017, for the period building up to April, the turnover declined by 300 billion compared to 2013 figure. A decline in trading by leveraged institutions and fast money traders and a reduction in risk appetite have contributed to a significant drop in spot market activity. Data were collected from roughly 1,300 banks and other foreign exchange dealers across 52 countries, so they are pretty accurate. As said seconds ago, the Forex market is not just about going to the bank in order to exchange one currency to another. Besides transfers of funds from one bank to another or country to another, speculation is an important dimension of the markets too. The major participants are commercial banks, brokers, authorized dealers, and also monetary authorities. Hence, it is the most liquid market in the world. The fact that national currencies are traded for one another makes it possible that there always is a move either up or down, so opportunities are endless. during the week. Adding to that, that the market operates fairly and free from manipulation or inside trading makes Forex a trusted source of trading currencies. Spot Forex is the simultaneous buying of one currency and selling of another at an agreed rate and principal amount. Unlike a spot transaction, where the value of one currency is traded once against another, the forward swap market is essentially an interest rate market traded in forward swaps points, which represent the interest rate differential between two currencies from one value date to another, and also indicate the difference between the spot rate and the forward rate. A swap agreement is a contract in which one party borrows one currency from and simultaneously lends another to the second party. Each party uses the repayment obligation to its counterparty as collateral, and the amount of repayment is fixed at the FX forward rate as of the start of the contract. Thus, FX swaps can be viewed as FX-free risk collateralized borrowing/lending, hence its turnover is higher than the spot market, as you can see that on the chart. And most likely, risk appetite is what led to the decline from 2013 to 2016. But note that those numbers were much smaller years back, where Forex was available only to a few, like the central banks, and other financial institutions that used to hedge and manage currency risk that arise as a result of their activities. It was back in 1996 that the evolution of trading platforms began, online trading. Web technology not only allowed retail Forex exchange trading to foster easy and fast ways for customers to access the market, but also currency pairs while making trades from their own computers. Access to the market was enabled through dealers and other financial institutions such as interbank brokers. This was followed by the development of easier to use interfaces and advanced features such as charting and technical analysis tools. The next stage saw the move to web-based platforms and mobile devices such as tablets and smartphones. Since 2010, there has also been a focus on developments to integrate automated trading tools and social trading into the Forex trading platforms. So let's look at this a little bit deeper. The Forex market is now composed of three primary segments. The interbank market, which consists of the group of financial institutions that deal currencies among themselves and make exchange rate quotations to clients. For example, market makers, central banks, and other financial institutions. Second, the retail market, which is primarily made up of individual speculators that trade on margin, deposited in a trading account with an online Forex broker. And last, the exchange-traded futures market, which although does not have a big impact in terms of volumes, plays an important and significant role for commercial traders and speculators alike. Large commercial banks might use the currency futures market to offset positions they take on from clients, as well as to establish speculative positions for large individual traders and sometimes even for the bank's own trading book. Hedge funds are also known to take on large speculative positions in the futures market, which they later unwind for either large gains or losses. Each of these segments in turn has a number of market participants types that primarily use that segment to execute currency transactions. The Forex companies allow retail traders, the everyday consumer trader, to enter the markets. Now let's look at how the Forex rate works. Remember the interbank Forex market? Well, in the interbank market, the term market maker commonly refers to the large financial institutions that make prices to others. The larger among these financial institutions typically act as market makers who provide Forex rate quotes to each other, interbank brokers and clients. In contrast, the smaller financial institutions, corporations, fund managers, and high net worth individuals who participate in the interbank market tend to act as clients to the large market makers. A client will normally have many liquidity providers in order to provide the best possible price to each own clients. For this, an aggregation engine is used that monitors all quotes and sorts the ask and bid quotes for its clients' orders. When a trader buys euro-dollar, the best quote will be provided, meaning that the liquidity provider that offers the best ask price will execute the trade. Profit or losses will be provided to and by the liquidity provider, while the broker operates as a middleman, making profits from spreads and commissions. Now, when a trader wants to either buy or sell, he will have to accept the Forex rate the liquidity provider is offering. Forex rates will be quoted in the base currency, otherwise known as a transaction currency. Euro is in this example. And the quote currency, this is otherwise known as the counter currency. And this is the dollar in this example. The price tells us how much quote currency you need in order to buy 1 unit of the base currency. Okay? So in this example, where we see the bid and ask rate in the MT4's market watch, we would need $1.24458 in order to buy 1 euro. This is the ask price when we buy. Now, on this slide, we simply see the currency codes. JPY, for example, is the Japanese yen. GBP is the Great Britain pound. Australian dollar, AUD, Swiss franc, CHF, Canadian dollar, CAD, New Zealand dollar, NZD, Russian ruble, RUB, Chinese yuan, renminbi, CNY, and there are many other pairs. You can have a look at the broker's MT4 platform. Now, out of those currencies, some pairs are called majors, some minors, and some crosses. Majors are the ones with the largest volumes. Those used to be euro dollar, dollar yen, pound dollar, dollar Canadian dollar, dollar Swiss franc, and euro pound. But over the past few years, as per the volumes increase, the Aussie and the Kiwi are also considered as major pairs against the dollar. Minors are the currencies that have low volume, like, for example, Euro Aussie, Euro Kiwi, Dollar South African Rand, and others, where the crosses are any pairs that are not pairs with either Euro or the dollar. For example, the pound with the Swiss franc, the Australian dollar with the New Zealand dollar, and others. Now, on this slide, we can talk a little about the bid, ask, and the spread. I mentioned on the previous slide that when a trader wants to either buy or sell, he will have to accept the Forex rate the liquidity provider is offering. Forex rates will be quoted in the base currency, okay, or the quote currency, known as a counter currency. When one buys the base currency, automatically sells the quote currency. The ask is the price paid to do so. The bid is the price that you will pay to sell the currency. The difference between the two is called spread. The spread is essentially the profit a broker or bank makes for you to enter the trades. In essence, transactional cost. The wider the spread, the more expensive it is for you to trade, whereas the thinner the spread, the cheaper it is to enter the trade. Large and frequently traded currencies usually enjoy a small bid-ask spread, while small and infrequently used currencies have a large bid-ask spread. Now, the spread becomes more important to traders who trade frequently, such as an intraday traders or even the scalpers. However, the spread is less important the higher the time frame you trade. Okay. Now, let's look at an example. You believe that the euro will rise against the dollar, and a company offering you the euro USD quote at 1.24456. This is the bid, and 1.24458 is the ask. You buy, so you go long at 1.24458. Don't forget that the ask price in a market is the highest price offered for that order, and that when buying, you will be given the highest price of the two. When you sell, of course, you will be given the lowest price of the two. By the two, I mean the bid and ask offers. Now, if you buy and then immediately change your mind and want to sell back to the company, you will sell at 1.24456, you will lose 0.2 pips. And this is called the spread. Now you may think, why 0.2 pips? Well, because the fourth decimal is officially recognized as the PIP on pairs with 5 digits, like euro-dollar, or as the second, it's officially recognized as the second decimal on pairs with 3 digits, like dollar-yen. The last digit is called pipette or micro-pip. A pip can be very small, okay? But a change in a pip can have a very big impact on your account. Now imagine this scenario. You took a deal of 100,000 units, okay, bought at 1.2442. Then sold it back at 1.2440, okay? So you just lost immediately $23, okay? Now let's talk a tiny bit more about the digits and pips. Currencies with one big figure left of the decimal place will have 4 decimal places. Currencies with anything above 2 figures on the left will have 2 decimal places, as dollar-yen, as the previous example actually. Since most major currency pairs are priced to 4 decimal places, the smallest change is that of the last decimal point, which is equivalent to 1/100th of 1% or 1 basis point. Okay? A fractional pip is equivalent to 1/10th of a pip, making it possible to view the Euro-USD currency pair with pipettes to 5 decimal places. Depending on the number of digits, the last decimal place is always referred to as a pip or pipette. For a trader to say, I made 40 pips on the trade, for instance, means that the trader profited by 40 pips. The actual cash amount this represents depends on the pip value. Okay. As for the tick is the minimum incremental price movement a currency pair can move. The tick size increment is expressed in terms of dollars. Now let's see how one can determine the pip value. Let's go through this example. Assume you opened a trade for 100,000 on dollar CAD and closed it at 10488 for a 20 pips profit. In order to determine the pip value for traded, we need to first find the pip value for the quote currency. Okay, that is the Canadian dollar. So we'll multiply the unit size with the pip. That would be 10 Canadian dollars per pip because we are buying 100,000 units. Okay. Next, we need to divide that with the current rate to find the pip value in US dollars. That is the base currency pip value. Next, we need to divide that with the current rate to find the pip value in US dollars, okay? And finally, we multiply the gains in pips with the dollar pip value to find the total profit. And that is 190.69 cents. Okay, let's see about the market types now. Starting randomly with OTC. OTC markets do not have physical locations, but are connected in a network of dealers, like the Nasdaq, for example. Some OTC markets are the spot market, swap options. Okay. Now the bond market. The bond market is the primary market where participants can issue debt. The stock market, which include buying and selling securities listed on a public stock exchange. Other markets, such as the commodity and real estate market, and also the derivatives market. There are several general derivatives markets, each containing thousands of individual derivatives which can be traded. But first, let's dig into the derivatives a little bit more. A derivative is a financial contract that derives its value from an underlying asset, transaction, market rate, or contingency, and creates a product. The underlying asset can be a commodity, a foreign exchange, equity, or any other asset such as bonds, interest rates, treasury bills, etc. But what mostly day traders use are the futures markets, options markets, and also the CFD markets. Now, a futures contract is an agreement between a buyer to exchange money for the underlying at some future date. For example, if you buy a crude oil futures contract, you're agreeing to buy a set amount of crude oil at a specific price at some future date. You can close out the trade at any time before it expires to lock in your profit, okay, or your loss. Now, options can be very complex or simple, depending on how you choose to trade them. The simplest way to trade options is through buying puts or buying calls. When you buy a put, you are expecting the price of the underlying asset to fall below the strike price of the option before the option expires. Now, if it does, you make money. If it doesn't, then you will lose the value that you paid for the option. And this is called the premium. If the option price goes down, then your option will decrease in value and you can sell it for more than what you bought it for. Now, with CFDs, if you believe the underlying asset will rise, you buy the CFD. If you believe the underlying asset will decline in value, then you sell or short the CFD. Your profit or loss is the difference between the prices you entered and exit the trade at. For example, if you buy a crude oil CFD, you are not actually buying into an agreement to buy crude oil, like as you would with a futures contract. Rather, in this scenario, you are just entering into an agreement with your broker that if the price goes up, you make money, and if the price goes down, you lose money. A CFD then is like a side bet on another market. Okay, in the derivative markets and in general in the Forex markets, the main market participants are Forex dealers in the interbank markets, which is mainly the banks, brokers, hedgers, speculators, arbitrageurs, central banks, and retail market participants, with retail, of course, being the least significant. Most of the retail participants participate in the spot market, whereas people with long-term interests operate in the futures markets. This is because these participants only buy or sell currencies when they have a personal or professional requirement, and dealing with foreign currencies is not a part of their regular business. A commodity market now is a marketplace for buying, selling, and trading raw or primary products. And there are currently about 50 major commodity markets worldwide that facilitate trading in approximately 100 hard and also soft commodities like oil, silver, gold, and corn, wheat, soybeans, and pork. Each commodity is priced in its own way depending on their classification and quantity measurement. For example, metals are measured in troy ounces, oil in barrels, wheat in bushels. Commodities are in their own asset class and integral part of financial markets. They're just different products. Investors use future contracts to facilitate the exchange of commodities. Commodity futures trade on various exchanges, depending on the type of the commodity, of course. They are standardized for terms, size, and units of measurement specific to the type of commodity being traded. But commodity traders are not as concerned about any of this or the value of the futures contracts, as they are about the change in value. There are two types of market types for commodities. Okay, the spot or the cash market and the futures. The spot is a market for financial instruments such as the commodities which are traded on the spot. In spot markets, spot traders are made with spot prices. Unlike the futures market, orders made in the spot market are settled instantly. Spot markets can be organized markets or exchanges or over-the-counter markets. A futures market is an auction market in which participants buy and sell commodity and futures contracts for delivery on a specified future date. The world's oldest future exchange is the Chicago Board of Trade. It was founded in 1848 by 82 Chicago merchants. The first contracts to be traded were for flour. The world's oldest futures exchange is the Chicago Board of Trade, CBOT. It was founded in 1848, by 82 Chicago merchants. The first exchange traded forward contracts were listed in 1864. A futures contract is a legally binding agreement between two parties to buy or sell an underlying asset sometime in the future. The quantity of the asset is fixed. The delivery or expiry date are also fixed. The contract is settled on a daily basis to show the current market value of a particular investment. That is, the difference between the base price and the settlement price are deducted from or added to the account of the respective parties. This is called mark to market. Mind you that investors can close out the position at any time before maturity, but no later than the contract's expiration, meaning risk is minimized from overnight positions, as the next day the settlement price is used as the base price. One has the right as well as obligation to buy an underlying commodity and at a future date, as well as the right and obligation to sell the underlying commodity at a future date. Right is the entitlement to profit. Obligation is when one has to pay for any loss, if applicable, of course. Now into forwards. A forward contract is a customized contract between two parties to buy or sell an asset at a specified price on a future date. A forward currency transaction is a special type of foreign currency transaction. It is an agreement between two parties to exchange two designated currencies at a specific time in the future, but these contracts always take place on a date after the date that the spot contract settles and are used to protect the buyer from fluctuations in currency prices. The parties involved in the contract are generally interested in hedging a foreign exchange position or taking a speculative position. The contract's rate of exchange is fixed and specified for a specific date in the future. So it is not directly tied to the rate on the day of the settlement, but is calculated based on domestic foreign interest rates, and the time of contract in days. But let's see an example of that to understand this a bit better. Assume you're taking a loan from a local bank in Canada. Obviously, you will be charged an interest rate for this, and then depositing that loan in dollars in the US bank. So you will receive interest. The interest you will receive will depend on the domestic and the foreign interest rates, as well as the period, which is 3 months of the forward rate in this example. Now allows the parties involved to better budget for future financial projects and know in advance precisely what their income or cost from the transactions will be at the specified future date. The nature of the forward exchange contracts protects both parties from unexpected or adverse movements in the currency's futures spot markets. Now, don't forget that this would this type of exchange will make you 1% gain on the interest rates. Okay. Now, to summarize with the futures and forwards on this slide, we highlight the main differences that set them apart. So futures are publicly known, forwards are private transactions. Futures are taking place on regulated exchanges, forwards between individuals. The price is recorded on futures exchange. The prices actually remain private in a forward contract. There is no risk of default, and the settlement is daily in the futures. And forwards have credit risk, physical delivery of cash settled, unless if there is collateralization agreement between the two parties. Now, the futures are regulated at the government level. Forwards are not. Now, indices. Indices represent the percent change of a market or asset over time in order to measure the market's performance. Most indices represent only a fraction of the actual market, not the market itself. The most popular stock indexes are the Dow, Nasdaq, Nike, FTSE, DAX, just to name a few, and represent a portion of the most influential companies in the US. Dow, for example, represents a quarter of the market's value and is the only major index that is price weighted, which means if a stock's price changes by $1, it has the same effect on the index, regardless of the percent change for the stock. So a dollar change for a $30 stock has the same effect as a $1 change for a $60 stock. The other stock indices simply represent different markets. For example, the S&P 500 is the most frequently used index by financial professionals as a representative of the market. It includes 500 of the most widely traded stocks and leans towards the larger companies, of course. The S&P 500 is a market capitalization or market cap weighted index, as are almost all of the major indexes. Weighting by market cap gives more importance to larger companies. So changes in Microsoft stock will have a greater impact than almost any other stock in the index. Other indices are the US dollar index, which is an index that measures the value of the US dollar relative to the basket of the 6 major foreign currencies. It is compiled as a weighted average of exchange rates of home versus foreign currencies, with the weight for each foreign country equal to each share in trades. Now, the VIX, or volatility or fear index as known, is a measure of the stock market's expectation of 30-day volatility implied by S&P 500 options, okay, which allows for a more accurate view of investors' expectations on future market volatility. The VIX is a computed index, much like the S&P 500, although it is not derived based on stock prices. Okay. Instead, it uses the price of options on the S&P 500 and then estimates how volatile those options will be between the current date and the option's expiration date. Index trading is considered safer for investors, but don't forget it can be as volatile. Now, let's leave the markets, the indices, the stocks now a little bit and go to a more interesting and much useful topic, leverage. Leverage allows a trader to take a much larger position that exceeds their actual investment, so that they have a somewhat larger position in this liquid market and mainly risk a minimum of their capital. So if you had $1,000, you can take a position of $100,000 with leverage, depending of course on the leverage offered by your broker. All brokers offer leverage, especially for Forex. This can be from 1 to 10, 1 to 200, and even 1 to 500. You may now ask, is this good or bad? Well, it is always twofold. Now, we said that leverage is needed for an order placed to move the market. So the smallest increment or decrement of change in pips becomes more costly. The more the leverage, the biggest the cost, but also the return. Imagine you open a 1,000 position with 1/100 leverage. If the market moves against you 100 pips, you're done. Okay, your position is closed. Now think this. If you have a leverage of 1/500, the risk you can take increases 5 times. So you would only be closed following a 20 pip and not a 100 pip move against you. Okay, now to get a better grasp of this, let's go into some more details. Let's see the lots volume and the turnover. Note that we mentioned earlier that one lot equals to 100,000 units. If you multiply this with the fourth digit, so 100,000 times 0.00001, which is the PIP value for most pairs, you will find that the deal value per PIP equals to $10. Okay, remember, 100th place, 2 places to the right of the decimal, is a PIP for yens, for the yen pairs. Okay, so let's see this example then. Example PIP value for 100K dollar yen. Okay, so we'll have 1,000 yen over 108, which is the rate of dollar yen. This is if this calculation gives us $9.2 worth of a PIP. So the PIP for the value is $9.2. Now the deal sizes are also referred to as lots. The standard lot size is 100,000 units, okay? But there are brokers with mini accounts that have changed the terminology where one lot is 10,000 units. This is not correct, Okay, it's not correct. One lot is 100,000 units. One mini lot is 10,000. One micro lot is 1,000. Now, volume is what is used to describe the size of the position, and turnover is volume times 2. In other words, the opening and closing of a deal is what is used to calculate the turnover for companies, banks, and also exchanges. Now let's go to the next page. Okay, understanding MT4 terminal details. This is the details appearing on your MT4 terminal when you open an order, and also other items that every single trader must fully understand before entering margin markets. We did speak about the leverage just now, so there is no need to explain any further. So balance is the amount of money you have in your account when there is no open position. If you deposit 1,700, this will remain unchanged until the position is taken and closed. Now equity, this is your account balance plus minus your open profit or loss, your P&L. Okay, this fluctuates based on the total of open positions you have. When there is no position, okay, the open balance, your balance and the equity are of course the same. Now margin, it's all about the margin. The margin is calculated based on leverage. However, let's forget about the leverage for the time being, okay? So when an account's leverage is set to 1/1, that means that there is no leverage. So your orders won't be able to cover any position, most likely, unless if you have a big capital to cover for your losses. So if you don't, you need margin, the amount of money that is secured for a position. Now, in the first scenario, if your leverage is 1/1, so you have no margin, and you wanted to buy 1,000 euros versus the dollar, you will need how much in your account, at least? Now let's have a look. Let's see. Assume euro-dollar rate is 1.25. Okay, that means that 1 euro is $1.25. So to buy 1,000 euros, you will need to pay $1,250. Okay, this is simply 1,000 euros times 1.25, which is the actual rate. Okay. Now, if you would have to pay a hundredth of or 0.01, which is actually the lot size, okay, of the money that you had to pay when your account was not leveraged. Therefore, to buy 1,000 euro against dollar, you have to pay 12.50, which is you know, 100 times less than the previous example. But let's carry on this example first. Now, so if you take 1,000 euro USD long position from your 10,000 account, we jumped a slide here, you will 1250 will be secured for this position. Okay, if you set your deal size to 0.01 lot, this is 1,000 units of a lot, and buy, then 1,250 from your account will be paid to buy 1,000 euros against the dollar. The 1,250 is called the margin. Okay, once the position is closed, the 1,250 will be released back to your account. Okay, plus minus your P&L, of course. Now let's assume your account has a 100-to-1 leverage. Okay, 1/100 with a 1,000 account balance. Now, in order to buy 1,000 euros against the dollar, you have to pay 100th of the money that you had to pay when your account was not leveraged. So therefore, you will pay only 1,250. That's 1,250 over the 100. Now, simply put, the required margin is calculated by using this simple formula: position value times the leverage. For example, 1,250 times 0.01, this is 1,250, and this is your margin. Now, free margin is the difference between your account equity and the margin of your open positions, or simply the free margin. Is equity minus your margin. For example, In this case, if we had a 1,000 account and we open a trade, we have, if we open the trade, we have 1,000 minus 1250. And this is 978.50. This is the free margin. Now, if the free margin goes negative, okay, no more positions can be opened. Now, the largest possible new position that can be opened is calculated by using the following formula. Free margin divided by the leverage. So our free margin from this example is 978.5 divided by 0.01. This is our leverage, 1 over 100. Okay, and this actually means that our free margin is 98,750, which is less than one lot, because we said that one lot is 100,000 units. Now the margin level is the ratio of equity to margin. Okay, in other words, equity divided by margin times 100. This is going to be 7,900% in this scenario. Okay, now the stop out level calculated and implemented by a company ranges from 10% to 50%, okay, of the balance. It is where deals will begin to be closed automatically because the margin level has fallen below the stop out level. Okay, this happens when equity decreases by increasing losses, or if the client overexposes themselves by opening too many positions, which increases their margin. And this is a very usual phenomenon. Now, altogether, just one as one example, let's suppose you deposit $1,000. Your leverage is 200 to 1. The maximum deal you can open is 200,000. Okay, and this is because this is your deposit 1,000 divided by 0.0005. Okay, because 1 over 200 is 0.005. Now your balance is 1,000. Your equity is 1,000 because you have no open trades. Your margin is 0. Your free margin is 1,000, and your P&L is 0. The margin level is also 0. Now, when you decide to buy one lot of dollar-yen and spread is 2 pips, okay, let's say you buy 100K because it's one lot at 1.008. Keep in mind that once the position is open, you are in a loss of $20 because of the spread. Actually, it depends on the spread. Okay, so find the equity, margin, free margin, largest new position, and the margin level. And the solution is simple here. Your equity is your balance minus the spread. So this is 980. The margin is the lot size times the leverage. So we'll have one lot. One lot is 100,000 units. So that'll be $100,000 times the leverage. This is 500. The free margin is the equity minus the margin. So that would be 480 in this case. The largest new position would be the free margin divided by the margin. Okay, and that will be 96K. And the margin level is our equity divided by the margin times 100. That will be 196%. So with this, this webinar is now coming to an end from my side, and I am ready to take any questions if you may have. So thank you for your patience in watching. And I'm ready to take any questions. I have 10 minutes to take any questions. So please go ahead if you have anything to ask. I see quite a few people been live at the moment. So if you have any questions, please go ahead. Before we close this, thanks a lot. Margie, you're welcome. Thank you for being with us today and watching this webinar. I'm pretty sure it's very, very helpful for new traders to understand what leverage is, what margin is, what markets you are trading, guys, most importantly. It's good to know where you put your money and investing. And Margie, yes, of course, there will be more webinars. There is a series of webinars. If you go on our website, you will be able to, one second. If you go on our website, you will be able to have a look. On our webinars page. Margie, you simply have to go on education and videos and webinars, and you will always find an updated list of our latest webinars there. One second. Let's just do this one more time. Education. Events and webinars. Apologies. So here, this is the today one that we have. Tomorrow we'll have the NFP webinar. Okay. There is technical analysis as per your question on the 1st of March, technical analysis webinar. Okay. And there is also a series of webinars recorded on our YouTube channel. You can go ahead and have a look at those. What is the best chart to trade? Jefferson de la Cruz. Jefferson, the best chart to trade, are you referring to a currency pair, or are you referring to time frame? Please elaborate. To discuss more technical details, yes, there will be a webinar on the 1st of March. Margie. Jefferson, if we could elaborate with your question a little, what is the best chart to trade? And if anyone else has any more questions, please feel free to ask. I will be here for another 5 minutes. So on the technical analysis webinar, we will discuss charting, okay, the charts. Okay, M15, M30 day. Jefferson, back to your question, because I see you are back online. It really depends on your trading style and your trading strategy. If you are trading on the 15-minute chart, it means that you're pretty much day trading and you don't leave trades overnight, which is good for managing risk. But then again, if you trade on the daily chart, it means that you're most likely to trade longer term and not daily. So it really depends on your strategy to answer your question. So on this technical analysis webinar in a month's time, we'll see charting, data representation, technical tools, price patterns, price-based indicators, volume-based indicators, the Dow theory, cycles, and also, of course, the Fibonacci. It will be a very good webinar for those that want to learn a bit more on technical analysis. Miguel Fernandez logged in late and missed half of today's webinar. Miguel, this webinar has been recorded and it will be available online on our YouTube channel probably by tomorrow. The attendees will receive an email with the link, I suppose, but in case you don't, my email is here. So please feel free to email me and I will send you the link. Okay, links on the YouTube. Okay, the YouTube, you can simply just go on YouTube and type FXPRIMUS. You will find us there. FXPRIMUS. Okay, So you can subscribe on our channel, and any new videos that come up will be uploaded here. We'll have a daily video, and we also have other webinars recorded, and they will be up there. Any more questions for today's useful webinar? Is everything clearly understood? What is leverage? What is margin? %. Okay, very good. Martinos Tionis, you're welcome. Is it okay to trade 1 minute time frame in Forex? Miguel, the 1 minute time frame is pretty much scalping. It's not really recommended, especially for someone who's new. I remember it's been a few months that you have started, so I would stick to trade the longer time frames. Scalping is very, very dangerous, very risky, and especially for people that are new. Miles, you're welcome. Thank you for attending. Please go ahead. I can take a few more questions for another couple of minutes, and then we can close this off. Mainly, if I was in your place, I would just note down those simple formulas, because it's good to know, and also write down that example. Okay, so that you understand your lot sizing, which is very important. There is many times that our clients conduct because they just keep opening orders, a number of orders, without understanding actually the how much they are risking. 30 minutes better, Miguel. 30 minutes is definitely better. Now note this: the longer the time frame, the not safer. I wouldn't want to say safer, but the longer the time frame, the more prone to the less risky actually it becomes for your strategy and also for your account. The 1 hour chart, the 4 hour chart, how can you analyze a trend if it's bullish or bearish? What is the signal? Jefferson, there is a lot of signals you can take from a trend. One simple move is the 50 moving average on the either daily or the 4 hour chart. If the price is above the moving average, the 50 moving average, then it is supposed to be an uptrend, and vice versa for the downtrend. Now there's also other signals, other indications. You can look at the RSI and have a 50% line in the middle, not just the 30 and the 70. Anything above the 50, anything above 40 actually could be considered as uptrend. Anything below 60 could be considered as a downtrend. There's also the momentum, if it's above 100 or below 100. There's also the MACD with the histogram and the signal lines, and also the divergence and the convergence. There is a lot of indications for a change, for a trend, and also the Bollinger Bands actually, which is the #1 indicator for a bullish or bearish trend. If price is above the 21, 25 moving average, which is the Bollinger Band middle line, if it's above, it's an uptrend. If it's below, it's a downtrend. Now note that an uptrend or downtrend cannot really be noted, identified early in the move. They can, but they couldn't be false. These indicators are going to be there in this on the 1st of March. Yes, from what I remember, I haven't prepared the webinar yet, to be honest, Margie, but there will be most of the indicators there. I'm not going to go into much details on them because otherwise this webinar is going to last more than 2-3 hours, but we'll just touch base of what each one does and how it can be used effectively. Okay. I will take one more question, guys. If I trade 0.1 lot size on euro dollar, 1 hour time frame, and I click buy or sell, how long should I expect to see a 20 pip profit? Miguel, the time you're asking me to give you an estimate of the time you should expect profit or losses. This really depends on the volatility of the market. Okay, if the market is illiquid, average there. Well, that's what I'm saying. There is really no average time of 20 profit, 20 pips. Well, if you think of the 20 pips, this is a very small move on the charts. Ajay, thank you very much for coming in. I can't wait to have you on the March webinar, and also tomorrow, the NFP webinar tomorrow. If you're able to attend, this will be also a great webinar. Miguel, if we say euro dollar, we are right here. This is a 20 pip move. You see, this is 20 pips. So it could take you an hour. But if you go down on the 15-minute chart, or let's go down on the 5-minute chart. Let's see this. 80, 10. Look, in 15 minutes, there was a move up of 20 pips here. So it really depends on the volatility of the market. 20 pips are easily either gained or lost when there is news releases, or when there is a break of a specific level. Okay, like here, for example, we had a break of this triangle. Or right here, we had a reversal. This is a reversal point, you see. So price just retraced and then moved up. And look at this. This is a big candle. Does it make sense, Miguel? It really depends on how volatile the market is. There is no average time. If you change the pips to 30, or okay, good, or 40 pips or 50 pips, obviously this would be much different, So back to our presentation. I'm gonna call this a day for this webinar. This is my email in case you're watching this and it's recorded also, and you have any questions, please feel free to send me an email. I'll do my best to get back to you as soon as I can. I want to thank you for attending and for watching another free to you provided webinar by FXPRIMUS and myself, Stavros Tousios. Thank you very much and have a nice evening.